Look, the economy is doing very well, but it doesn't guarantee that it's going to continue. Usually when you have this strong economy with such a period of time, there is going to be year-on-year weakening. You know what I mean? In other words, what it looked great last year comparing to this year will indicate a slowdown, which basically is not very much of a slowdown.
If that is indeed the case, then what do you see as the biggest risk for the US economy? You know, if we're focusing on that part of the world for the moment, I mean, what would the catalyst then be for a slowdown coming towards the end of the cycle?
The big catalyst will be a loss by Trump in the election. That will be a big catalyst, because I think the markets then will go haywire, because they've been depending on Trump policies to keep on pushing the market up and also higher growth rate in the U.S. If Trump loses, then it'll be another game.
Can you read the tea leaves, though? I mean, I know it's still a ways out, but that prospect doesn't look likely right now.
It doesn't look likely now, but if you look at the press, their sentiment against Trump is overwhelming.
Oh, and it is growing, isn't it?
Yeah, it is growing. So that's why I'm a little, concerned about this.
Okay, all right.
But Mobius, what about the inflation risk? Because in all this talk, with rates going down in emerging markets, rates going down in the US, we haven't quite seen that easy money flow through in, leading to higher inflation. Asset price inflation has happened, but it's not actually filtered through core inflation, right? And so how do you see, when do you see that happen? When do you see numbers pick up? Because the fear is that when they do, it'll be very quick, it'll be very swift.
This is the real dilemma. This is the real dilemma that the Fed and all these central banks face, because they're talking about, we got to have 2% inflation. Why 2%? It's on some theory that they think this is great for the economy. The reality is, globally, we are in a deflationary trend. I believe that going forward, it's going to be very, very difficult to achieve this 2% inflation rate. Simply because, things are getting cheaper, technology is spreading around the world and creating a situation where products and services are going down, not up.
Structural changes in the economy.
Structural changes, and there's a real dilemma that central banks have. On the one hand, they want to see inflation at 2%, but it's not getting there, it's going down. On the other side, they want to see growth, and they think that, well, if the 2% will have growth, well, if we're not getting there, then let's cut rates. It's a real dilemma for central banks.
This is very simple, but also a very broad question. If we are in a deflationary environment going forward, then does that mean it's going to be harder to invest and make money?
Yes, it's going to be much more difficult and challenging, and this is the reason why I've been saying that, let's look at dividend-paying stocks. Because with rates going down and with savings rates going down, people putting money in the bank are not going to get any interest rates.
Yeah.
Then they're going to be looking at stocks that pay good dividends.
Yeah.
So this is what I'm emphasizing.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.